Good afternoon again, and
Thank you.
So I will guide you as to my presentation. You can then, I can say, next slide, right? Value chain opportunities, and how do we take advantage of this investment gap? We believe that the approach through a blended finance approach, we believe, can work in Nigeria, and I dare say in some parts of African economies as well. So you can go to the next slide. And it's very clear. We walk through the understanding of these opportunities I spoke about earlier and the gaps, and how to leverage our blended finance approach to access these opportunities, and then a conclusion and next steps of what can be done. Next slide, please. Yeah, next slide.
Okay, can you see the next slide, section 1?
Yeah, well, yeah, everyone can read that one. I think it's just
okay.
Yes, then go to the next one again. After the opportunities, go to the next one. Right. So if we start, the baseline endowment of Nigeria for agriculture and agribusiness investments are what you can see on the slide. We have these natural endowments: land, water, sufficient labor, and market of 200 million people. These are potentials and opportunities. As you can see, 84 million hectares of arable, billions of cubic meters of water, subsurface, surface, many rivers, predictable rainfall, more or less, labor that is very competitive in pricing, and then there's huge domestic market for industries and the consumer market, not to talk of those commodities that can be produced competitively for export. Next slide, please. There are a lot of key drivers for these opportunities in Nigeria. Very focused government policy, both on the monetary side as well as the fiscal side. Population growth that is fairly rapid. Urbanization that is moving apace. We have 36 or 37 state capitals, including Abuja, with a test for food that is different from the rural area, all required to be fed, to be clothed, and to be taken care of. We have a rising middle income. And I think in the last few years, it's estimated that total import bill for food, feed, and fiber for Nigeria was something in the region of $22 billion US. Of course, it has substantially gone down because of the focused policy of the current government. But this was our story some years ago. At a global level, we all know that according to African Development Bank, I think, that the food import bill, if care is not taken for Africa, would be about $110 billion by 2025. The other driver, which can be looked at as an opportunity, the African Continental Free Trade Act that I think Nigeria ratified just last week. Rapid population growth at African level, global food industry at $5 trillion. And the opportunities, if you look at it that way, that may pop up as a result of the US-China spat that is, I think, ongoing. All right. So these are some of the drivers. Yeah. So again, in terms of the opportunities, we have an agricultural economy in Nigeria that's than the overall. The green, which is the agricultural sector contribution versus the rest of the economy, is always been high. In fact, the most dramatic one is the performance in Q2 2020. You can see while the rest of the economy dipped by -6.1, agriculture still managed to post 1.58 in growth. So even in periods of recession and negative overall economic growth, agriculture still manages to maintain positive trajectory. We believe that with additional capital support, these opportunities can post bigger growth for the agricultural sector in Nigeria. Next. Again, to further drive in the point of the opportunity sets in Nigeria, look at a sample of just 4 commodities. We have between 18 to 25 commodities that Nigeria uses today. But if you take example of the key staples, look at dairy. Nigeria imports about $1.3 billion of dairy per annum, dairy product. import about 3.2 million metric tons. So the demand for fish is about 3.2 million metric tons. Local production it's about 2.2. So a supply deficit is very clear there. And that's a static information because by now with population growth, that number would have gone up. If you look at wheat, we import, the demand for wheat is about 5.3 million metric tons. Local production is just a quarter of $4 billion per annum. Cassava has one of the biggest potentials with a net worth of $8.5 billion, and that can be converted to a lot of commodities in country. Ethanol, which the Nigerian National Petroleum Corporation imports to blend for fuel. The starch industry, the pharmaceutical industry, the paper industry uses huge quantities of starch. Animal feed, blend for flour, for bread. Yeah. According to McKinsey, some years, a couple of 2-3 years ago, according to their estimate, the Nigeria agricultural production can be increased by up to 160% by 2036 by leveraging just 3 key drivers. One of the key drivers is intensification of yield per hectare of even the existing hectares. If we can be able to push production by large farms, agricultural economy like Bangladesh and others, that's a key driver. Other thing is if we can move from basic bulk commodities to high value commodities like dairy commodities, like horticulture. McKinsey, Nigeria's production can be increased by up to 160% to the tune of 38.4 trillion by 2036. To put it into context, the entire federal government budget of Nigeria for this year, including deficit financing, is about 13.8 trillion or so, 13.3 or 13.8. Imagine a sector, the agricultural sector alone, contributing 38.4 trillion to the economy of Nigeria. That's about three times of total federal government budget of Nigeria. That is the potential by 2036. Next slide. So, having stated the opportunity set, the background, we need to now zoom down to how to structure those opportunity sets. We believe that the Nigerian agribusiness opportunity presents huge prospects and opportunities yet to be tapped, which is what I mentioned earlier. But you don't approach those opportunities through an unstructured manner. We believe that every single commodity that can be leveraged for production can be structured in such a way that you can make business case for the upstream, midstream, and downstream segments. It doesn't matter which commodity. It can be cassava, it can be poultry, it can be fishery, wheat.
Sorry, I think we keep losing your mic a bit.
I need to know that they can still hear me. All right?
Okay, now we can hear you again.
So if you take any commodity, take, for example, rice, which is one of the key commodities today in Nigerian agricultural economy, it has that logic too. You have the upstream, midstream, downstream. For us in NIRSAL, to make sense to finance and investors, we have to break them down into their component parts, into the agribusinesses. It has to have a business logic before finance can listen to you. For example, instead of asking banks to finance agriculture, we are past that stage. We have learned to approach banks with a simple logic. Can you finance a fertilizer business opportunity? Can you finance a seed business opportunity? Can you finance a crop protection product opportunity? Can you finance tractor and equipment hiring opportunity? Can you finance research for innovation opportunity? Can you finance those that can provide extension services as a business? And can you finance some services? If you are able to convert upstream opportunities into business logic, we begin to see a bite from the banks, because you are no more approaching the banks by telling them finance farmers for me or finance agriculture for me. That means everything and nothing in particular. But by smartly getting the banks to finance the upstream business activities for which they have standard products. When you approach a bank and say, finance fertilizer opportunity for me, for a bank, this is a trade finance opportunity. It's up to you as an institution like NIRSAL to stay at the 30,000 feet level and understand when fertilizer is financed, are you able to map it to the opportunities in the upstream segment? And that upstream segment essentially is the primary production part. And then you can finance that one separately, and then the midstream and the downstream. Like I said earlier, by breaking down all the commodity business logic into their component to finance business opportunities that they are used to financing. As you can see, if you go to the midstream, financing processing is a shoe-in for bankers because they know about processing. Packaging, wholesalers is a trade finance, and even haulage operation by trucks. That's a kind of financing they are used to. But if you are not able to integrate it for a commodity value chain like rice, then you don't really make sense out of it. But someone, like I said, an institution like NIRSAL has to sit in and try to provide that logical link between all the elements. Next slide. So, what are the investment gaps? Having defined the opportunity set, having defined how to approach finance and investment by breaking down opportunity sets in Nigeria, natural endowments, the land, the labor, the market, and the water availability. But those are endowments, except we map those endowment opportunities to capital. There is no way you can convert them to economic business logic. So we have to have four capitals, essentially. The human capital has to be available. You either hire, you acquire, you import, whatever it is, you need to have a step change whereby the capacity to design a project, to control a project, to deliver a project has to be there. If we don't have that kind of capital, the good thing about the global capital flow today, even human capital, you can unlock all these three other opportunities. In financing, next slide, please. So in financing the agricultural sector, next slide, there is a trend of improvement of financing because of the support. Now the slide before that. Yes. So in Nigeria in the last 5 years, there has been a trend of, in the last 5-7 years, there's been a trend of increment. 20, you could see the level is about 4.8% by the banking industry. Again, capital importation by foreign investors has gone up to 2.04 by 2019. Now, this appears to be progress, but the opportunity set demands much more than that. So there's still enough room, a lot of room for improvement in that scope. Next slide. But there's a big but. We have realized that there is the opportunity, there is the capital, but investors and financiers, in our experience, have traditionally been averse to just going ahead and putting their money against these opportunities. And we have learned that there are so many issues that really are in the minds of investors and financiers. First of all, the agricultural value chain in Nigeria hitherto has been broken value chains. You cannot see an organized set of primary producers in a particular region of Nigeria. There's no link between input, which is the pre-upstream part, to the primary production part. Primary production is not linked to processing, the midstream, and processing is not linked to the downstream market. So everything is broken, everything is disorganized. In that kind of scenario, finance and investment finds it very difficult to follow the money. That is one. Two, on the side of the agricultural actors, particularly primary producers, the farmers, there is poor understanding. On the side of the banks, in addition to that, there is poor understanding of the agricultural sector itself, its dynamics and its imperatives. Most banks approach agriculture like the standard financing models they do for oil and gas, for telecoms, for trade, for manufacture. Agriculture has its own different dynamics. And then bankers have high risk perception for agriculture, and that also reduces their appetite. On the side of farmers and borrowers on the farming side, they regard the credit assessment procedure for banks as very complex. It's difficult for farmers as individuals, even as groups, to be able to meet up those requirements. Again, from the part of the banks, they find it difficult to create financing of $1,000 to a remote farmer somewhere 2,000 kilometers in a corner of Nigeria at $1,000, and that adds to the transaction cost. The farmers are not structured, they are not organized, so that a ticket size is economic enough for a bank to finance it. And banks complain that there's poor visibility and control over cash flows. It's one thing to create the loan, to open the vault and disburse the loan. But once you disburse the loan, information asymmetry kicks in. Most bankers don't know the fate of their investment or what that happens to their money until probably months later you cross your fingers and hope for the best. And that is not good enough to be able to attract bank financing in particular. But surrounding that, there are other macroeconomic issues: poor agricultural inputs, infrastructure, price volatility. All these are things that, with the support of policymakers, can be resolved. And so these are some of the approaches we do to give comfort to financiers and investors to put their money into these opportunity sets. Section 2. Yeah, next one. Next one again. Right. So how does NIRSAL do its business? That is why we said a blended finance approach is the way to go. We provide holistic and sustainable solutions for Nigerian agriculture and agribusiness financing. In the middle of this slide, you could see at the center is the blended finance approach. And as the cycle shows, any blend finance institution must have technical assistance built in. You must be ready to do direct proof of concept investments, no matter how micro it is, to show investors and financiers that it can work. You must be able to have a key product called credit risk guarantee. That you can begin to talk to investors to attract private funds into agricultural opportunities. Now, supporting that would be, you must be able to develop innovative agribusiness models for the upstream, midstream, and downstream segments. So even if there are opportunities, if you don't develop a business model and present it to the banks, to the investors, you find that it's difficult for them to really put out their money to do all that, because this is the public side of things. You need to develop business model to show them that it can work. This fertilizer financing I'm proposing, it can work. This irrigation model I'm proposing can work. This equipment purchase and service provision can work. You have got to show a business model that is stress tested, that it can work. Of course, in addition to those two, you must be able to surround your value proposition with robust and proactive management of agricultural risk through precision agriculture, robust monitoring, and proactive loan management. Next slide. Next slide. Yeah, so NIRSAL deploys its services and activities by leveraging its $500 million capital. As you can see how our capital is distributed. And this is how we support our activities: risk sharing, insurance development, technical assistance, rating, and incentive. It's, I think, self-explanatory. Time is not with me. Let's just keep moving very fast. Next slide, please. Yeah. So the NIRSAL way focuses on four fundamental approaches. Everything a risk sharing facility can do to support financing for agriculture must be based on four fundamental principles. This is out of our experience. First of all, any commodity value chain that you. Number two, there must advantage. You don't grow, for example, maize in the coastal area and think you are going to optimize it. In Nigeria, there is the typical area that's called the maize belt. You have a higher probability of success when you put finance and investment in the maize belt of Nigeria, and you want to support cocoa, you have a higher chance of success when you put cocoa investments in the coastal parts of Nigeria, like Ondo State, like Cross River State. So you must follow every commodity by its ecological advantage. Number three, you must have a smallholder inclusion and optimization. Because really land ownership in Nigeria is largely owned by the smallholder farmers. But when you do a value proposition to them that provides a win-win scenario, they tend to behave themselves and they tend to cooperate, and that works. And then you must have an integrated value chain based business models. And this is the kind of thing that bankers find attractive. Now, let me skip the next slide. It's basically what I've spoken earlier about how to go to the next slide. I'll just mention it quickly. So we developed a model a concept called the mapping to markets. That means every segment in a commodity value chain must be mapped after it. Required, the fertilizer required, the seed required is available and is financed. We cannot still support the primary production, that's the farmers, until we know that the offtake, who are the off-takers, what quality are they looking for, what quantity, what specification, that is sorted and financed, so that you have mapped all the actors horizontally along the chain, and that is a robust risk management approach. You find that when you do that, cash transactions among chain actors is minimized largely. And we know that for farmers, almost 80 to 85% of any loan you create for them should go to input. So why should I create a loan? There is always a risk there. So we try to make sure that all farmers that are grouped are mapped to their inputs and are mapped to. Yeah, so again, we leverage a lot of science, technology, and innovative tools in our risk management. You can see the value chain logic. Under that value chain logic, we try to ensure that we do a lot of geospatial mapping, field structuring, mechanization is in place, climate smart irrigation, comprehensive field monitoring to give comfort to banks. And there is what we call the PHP3. It's one thing to produce massively. If you don't capture value at the point of harvest, primary processing, primary transport, and primary storage, you tend to lose value. So we make sure that we create technology services as a business to ensure that this value is captured and transmitted downstream the market. Next, next. We're almost done, I think. Yes, these are samples of already models we have developed, pre-upstream, upstream, midstream, and downstream. A typical case in point is the agro-geoco. The next two slides, please. Yes, next one again. That's the geo-cooperative introduction. So we try to make sure the smallholder farmers are brought together. It's difficult, we find it difficult to get banks to provide financing when farmers are disaggregated, they are unstructured, they are just scattered. So we try to use social engineering techniques to ensure that farmers are brought together into three levels. The least level that we operated, which can be economic model for us for financing, is what we call the cell. The cell is basically 10 hectares in one contiguous area. The next one is the block, 50 hectares in one contiguous area, and then that can be financed. Next, please. Next slide. As you can see, if you go to the bottom of the left side, farmers are normally operate at less than 0.5 of a hectare to 1 hectare. That is not good enough for finance and risk management. Like I said earlier, we try to move them into cellular arrangement of 10 hectares or a block of 50 hectares, or the most optimal, a block, a geo-co-op of 50 hectares. And there's the reason why we say geo-co-op. If it is the land that makes the farmer, not the other way around. So we don't use the normal cooperative approach. It is the geo, that is the land, that makes you cooperative. We tell the farmers that, look, when you go to the ground, actually you guys are neighbors. My little plot of land is neighbor to you. If you go to the next slide. Yeah, time is against us. Yeah, next slide, please. Yes. So in the pilot outing for our geocorp formation, you can see the map of Nigeria. You can see regions of Nigeria where because the northern part of Nigeria is actually is the grain belt. You have massive uptake of because land is available there. You have more geocorps being formed there. In the southern part, because of the nature of land ownership, there is less. But almost all parts of Nigeria are taking up the geocorp formation. We have been able to get up to 100,000 applications. We have been able to have up to 2.5 million hectares indicated. And so far, based on this, we have been able to entice banks to say it goes to the input suppliers, the mechanization guys, the crop protection guys, the seed guys, in such a way that they are mapped to these farmers. Yeah, next slide. We are almost done, I think. Moderator, if time is, you can always warn me to wrap up quicker. You can go to the next slide. Yeah, so that explains what I just said earlier. We can just move. This is the opportunity set. 4 million hectares. This is our target. We want to structure. Could you go back to that slide, please, quickly? No. Yeah, that one. So you could see our target in NIRSAL over the next couple of years or so is to structure up to 4 million hectares. And we believe the cost of primary production on those 4 million hectares alone will be something in the region of $4 billion US, projected to generate a gross revenue of $6.5 billion US, and at an average market price less cost. This is just a back of envelope calculation. We believe that farmers, when they are supported, they are structured, can generate up to $2.5 billion US in profits, particularly when yield is improved, quality seed is used, the farmers are organized, the mechanization is sufficient. We believe that this can be achieved. Next, please. Yeah, this is just one model that is the integrated private agribusiness investment model, whereby we work with landowners, corporate landowners, and we work individuals in society that basically have pieces of land that are big, but they don't know what to do with it. 5,000 hectares, 10,000 hectares, 2,000 hectares are available, but these are owned by the high net worth so that there will be no disturbance in terms of the operation of the investor. And we're getting an indication of interest. So far, I think in our land bank, we've been able to have indication of about 120,000 hectares. And on these kind of privately owned land, this is the kind of business model we want to develop, where you have the baseline investment opportunity, you produce the commodity, you do value-added processing on site in order to service the markets. Next. Yes, so this is basically to indicate that we have been able to contribute in moving the agricultural sector from indemnity-based insurance product, which is the standard product in the Nigerian insurance market for agriculture, to the index-based insurance approach. Today, we are able to get the national insurance regulator to register up to 8 insurance companies, and some of them have already started providing index-based insurance. And that speaks to specific value chains, to specific risk challenges along segments of the value chain. Next slide. Our key product is the risk guarantee, whereby we provide 75% credit risk guarantee on the face value of the loan, including interest and capital. For mechanization, 75% guarantee. For those in processing, 50% of guarantee, integrated farm 30%, and logistics and agro dealers would have 30% guarantee provided by NIRSAL. Let's go to section 3 and the last section. This is the very last section. Yeah, so it's just a bit of history of NIRSAL. As a risk-sharing facility, NIRSAL is owned 100% by the Central Bank of Nigeria, but we have the Federal Ministry of Agriculture sitting on our board because the policy space is owned by the Federal Ministry, and the Bankers Committee, which comprises the CEOs of all the banks in Nigeria, they have a seat on the board. And below that, some of our key objectives and targets. Next slide, please. So these are our results so far. So far in our little existence of about 600 million in financing, we believe we have created direct jobs of 520,000, and probably indirectly up to 3 million. And so the call to action is the next slide, and that is the last. Yeah, so we believe that investors across Africa and across the world can take advantage of NIRSAL and the fact that we have boots on ground. We understand Nigerian agriculture, we understand risk management, we understand the nexus of development agriculture, financing agriculture, and risk management to support investors, to provide a clear roadmap for them, to reduce risk for them in order to take advantage of these opportunities in Nigerian agriculture. So the next 2 slides, I think, is a thank you, ladies and gentlemen. Yeah. So last slide, please. It's a thank you slide. Yeah. Great. Thank you, guys.
Great. Thank you. Thank you for that presentation. I know we went over time a bit, but it was really good, really interesting. Thank you. Unfortunately, we won't really have time for any questions now, but I'm sure they can reach out to you then. And if there's any other questions, they can contact you directly.